the house for the last 10 years or so. And during that time period, we work with employers to build custom benefit programs. But one of the things that we really focused on over the last year or so is the employee retention credit. And I'm sure some of you were on the call. There was a call probably back in August that Aka and NCAL did with BKD and Plant Moran. And they really went through a deep dive of the employee retention credit itself. But right at the end, they said, but we're not going to be able to help you with this. You really need to work with an expert to be able to, go through these waters. So our good friend Mike Wiley and myself took it upon Compass to go out and start interviewing who we thought would be a good partner for the membership. And we interviewed 6 or 7 different groups. And what we realized during this time period is that there were a lot of startup companies that had only been in business 3 or 4 months, and they weren't going to really be around to work with the membership over the long term. Or there was a lot of companies that were charging egregious amounts to work through this process. Or a lot of companies that were just giving misinformation to the membership, not really understanding the business of skilled nursing and assisted living. So as we continue to vet everyone out, we chose to work with LG Resources for a few reasons. The first, probably biggest reason I would say, they have 6 current or former IRS agents on their staff. So they really understand how the IRS works through this process because they're on the same side as the IRS. Second, they gave us a great member benefit. They're doing the education. They'll actually do an analysis upfront without being under contract for anyone. So they can tell you down to the penny through their analysis exactly what you are eligible for and if you are eligible for this program without actually contracting with them. And then if you want to contract with them, that's fine. If you want to try to do it on your own or if you want to work with someone else, just making sure that everyone gets the proper education on this is the most important thing for us today. So, I think that with LG's longevity, they've been in business for 16 years. They've done about 20 facilities for us in Pennsylvania so far. So they are familiar with the landscape of the state as well. So, I think we've got a great resource in Brett Fritz today and LG Resources to be able to give us the education that you guys need to be able to better understand the 400 pages of this, but specifically, the employee retention credit, the 6 major changes that have come about from this, and help you determine if you are eligible and if you could continue to, work forward towards this. Mike, is there anything you want to add before we turn it over to Brett?
Nope, nothing at all. You did a great job, Nick, as always. The only thing I'll tell you is, just from a definition perspective, and I know you're aware of this, but in PA, there's both personal care and assisted living.
Great.
There's a lot more personal cares than are assisted living, but just from a knowledge perspective. So everybody's aware, and just to clarify that for Brett's purposes.
Thanks, Mike. Over to you, Brett. Oh, you're on mute, Brett.
There we go. Nick, Mike, thank you for the introduction, and Kimberly, thanks for hosting us today. We appreciate the time. As Nick said, we want today to be all about just education, and your organization has probably been introduced, spammed, getting cold calls, emails from people saying you qualify, go get this money. It's a great program for you. And that's not always going to be the case. As Nick said, there are a lot of pop-ups that have come up in this industry over the last couple months. I call them ambulance chasers because they're trying to chase the money. And today's purpose, again, is just all about education. Make sure that everyone is aware of what this employee retention credit is, how it operates, how it's changed, how it can be a benefit to you and your organization. But but there are some questions that come up typically. And so we want to make sure that everyone's got a good knowledge base here for the next 30, 40 minutes or so. And then we will have some time at the end for open Q&A. If anyone would like to ask some questions, please go ahead and kind of jot those down, and we'll address them at the end. As Nick said, our company's been around 16 years. So LG Resources, we're a staffing and payroll company. We're based out of Utah. My team and myself as well, we're all remote. I sit in Charlotte, North Carolina. Yeah, over the last 2+ years now, we've been helping businesses with this employee retention credit. Over all industries, all states, we've serviced about 7,000 different businesses. So we're very deep into the weeds. And as Nick said, we've got former and current IRS agents on staff. And then our processing went through about a 6-month, really intensive compliance and vetting review to make sure that we were doing everything under IRS compliance. As such, coming out of that review, we now have 2 attorney generals that actually sit on our advisory board. They're volunteer, non-paid positions. They both said, "Yep, we believe in what you're doing. Let's go help this industry out," because there is a lot of bad information that's out there. So again, thank you for having me. Excited for today. Let me dig right into this. And some of this may be information that you're not that aware of. Some of it you may have heard quite a bit about, but I want to make sure you're getting the truth of the matter for today. So what is the ERC, the Employee Retention Credit, or the Employee Retention Tax Credit? Ultimately, this is a payroll tax credit. It was introduced during the pandemic. So everything that we're going to talk about today does go backwards in time. We're going to talk about 2020 and 2021. The full time frame of when this came available was actually March 13th of 2020. That was day one of the pandemic. And then it actually concluded on September 30th of 2021. And we'll talk about why and some of the changes around that, because as Nick said, there have been several major legislative changes. But ultimately, this is for businesses that have a couple different things that they have to take place. You have to have W-2 employees. That's really important. If your industry does, but if you're a business that has just 1099 contractors or cash payments, this is not going to fit for you. And the reason for that is that the way that you apply for this tax credit is actually amending a payroll tax form. Specifically, that form is called a 941. It's a quarterly tax form. Many of you are probably aware of it, or someone on your staff sends it to you once a quarter and says, "Hey, sign off on this." But if you're not aware, that this is a quarterly tax form that the IRS asks for what were your payroll wages and withholdings of the previous quarter. So on that form, there are actually some sections that now talk about the ERC. Now, businesses that did not take advantage of this in the time frame of submitting those 941s can still go backwards and amend those 941s with what's called a 941X. In doing so, you'd be able to just fill out those sections, send it back to the IRS, and then they reprocess. And they'll say, "Oh yeah, we see that you're reprocessing your tax exposure." And at this point, they'll send you a refund. So this is actually physical cash that does come back to you if you qualify for it.
Brett, I want to clarify one other thing on the W-2. I know a lot of you may have used agency during this time period, or some of you outsource particular departments, be it housekeeping, or may have a therapy department that's outsourced. These have to be employees, W-2 employees that you own. You have paid to outsource those employees. That particular company may be eligible for those employees that have worked in your buildings, but these are specifically only W-2 employees that sit on your form 941.
Yeah, that's a great point. We do run into that in your industry because of agency, because of different management companies that might be coming in, and so yeah, that's really important. It is those employees that you own. Essentially, you're paying their taxes. So that's piece number one of how you can become eligible. Piece number two is that you have to pass a qualification test. There are a few different ways to qualify, and we'll talk about those ways today. Now, those ambulance chasers that have popped up, many of them are just going around saying you automatically qualify. All you have to do is sign your name here. And that's really scary for this industry because those businesses that are blindly qualifying for this, you could get in trouble down the road because the IRS could come back and ask questions and do some audits on this. So you want to make sure that if you do take advantage of this, that you truly are a good candidate for it. And again, we'll go through some of the steps around this. Now, one last point I'll mention, and this is what Nick mentioned at the top of the hour here. This legislation has changed numerous times. So as we get into this qualification, I'll show you and tell you some of the changes that took place, how it started one way and then it evolved into a very different qualification methodology of how businesses can get this. So we'll go through that in a little more detail here in a second. And then the third thing I'll mention here is that the size of your employee counts, again, those owned employees that you have that you pay taxes on, that matters. Because again, this is part of the legislation around who and what can be available to get what when. So let's take a quick look at that, of what that looks like. So everything we're going to talk about here today for qualification of this ERC is going to have a baseline look of 2019. So that's always going to be what we're going to compare against. That was pre-pandemic. And then we're going to look into 2020 and 2021. But the size of your employee count definitely matters. So if you had an average full-time equivalency of W-2 employees, again, I know that's a mouthful, but average FTE employees in 2019 of under 100 employees, then you can qualify for 2020. That's available to you. But as soon as you get to 101, or more employees, then you cannot qualify for 2020. It's just not available to you anymore. It's not because the IRS doesn't like you. It's that's just how the legislation sits. And so that is only going to be available for 21. So again, let me say that again. If you're under 100 employees, you can get 2020 and 2021 qualified availability. But if you're over 100 employees, then you can only get in 2021, as that's how the legislation sits. And then additionally, if you're a large employer, in the eyes of large employers, you have over 500 employees. Again, back in the baseline of 2019, 500 employees. You're considered a large employer. You still can get this ERC, but it's a lot more complicated. It's a lot more difficult. The calculation is different. So if you are a large employer that has over 500, or you're an aggregate control group, where you might have multiple entities that have shared majority ownership between all of the entities, all of your individual entities roll up all of your employees, that could put you over the status of being a large employer. This is a very confusing part of the code, and a lot of people struggle with what aggregation means, what control group means, what your total FTE count is. I mean, Nick and I just yesterday we're working back and forth with an independent owner that they're right on the cusp of being over 500, under 500, because they have a lot of part-time and full-time. So this is an area that we can help advise on, just to make sure you're doing things right, because you want to make sure that you do things under the legislation of the IRS. You don't want to trust someone's blog, someone's opinions. You just want to say, this is what the IRS says, and I'm doing it the way the IRS tells me to do it, because that's what's most important. Right,
Brett,
so
let's pause here for a second again, because I'm thinking about one other thing that's going to be applicable to this group. All ancillary companies as well. So if you have an adult daycare, if you have a home care company, if you own a pharmacy that has additional employees, all of those companies are considered part of an aggregate control group, as long as that ownership model and ownership structure, majority-wise, is very similar. Now, Brett, I know that there is also some component of this law that states, as a management company, if one of your companies qualify for this, more than one can qualify. Can you explain that as well?
yeah, absolutely. There's actually a couple of different parts that I'll explain there, and thanks for bringing that up, Nick. So to the point of your multiple entities, if your organization owns, let's just say, 2 entities, you've got a just a standalone assisted living, then you've got a management company, and they're under separate EINs or tax IDs, and you have payroll that runs through each individually, then essentially they will be considered 2 case files. that could potentially qualify for the ERC. And they still have to go through the rules and whatnot. What's unique about management companies, though, as Nick said, is it just becomes a pass-through, because management companies are simply just doing that. They're managing an operation. And so the IRS recognizes that, yes, that organization who's got the payroll may just be a pass-through of operations. And as such, then you can look at the operations side to determine if the management piece is qualified for it or not. So that's piece number one. Piece number two is all about multiple locations. So if you have, if you're an operator that has, let's say, just 2 or 3 individual assisted livings across facilities, and they're in different parts of town, or maybe they're across state lines. If you own in multiple states, then you can actually use that to your benefit, because again, under the legislation, the IRS says that if you have one piece of qualification in one entity, that will be inclusive of all of your other locations or entities as well. So as we talk about these qualifications, think about that, right? If you have multiple entities, you might say, hey, my assisted living on the left wasn't impacted as much as the one on the right. But if you own both, then that actually can encompass everything there because of the way the legislation sits. Okay. Good questions, Nick. This is great. All right, let's move forward a little bit. Let's talk about how to qualify, because I think this is the piece that's really going to dig into the weeds here a little bit. So I want to spend quite a bit of time on how this operates. Now, as I mentioned up top, and Nick mentioned, the legislation has changed several times. There's been 6 major amendment changes to this ERC. So let's start with what it initially was. So on March 13th of 2020, the initial way to qualify, the only way to qualify, was if your business had major decline in gross receipts, major decline in revenue. Okay, so this is what we call the revenue test. This is still available as a test for qualification today. Now remember, we're always going to use the baseline of 2019 versus a time frame in 2020 or 21, depending on the size of your employee base. So for the revenue test, again, it's very, very dramatic. The revenue test, you have to be able to show a 50% decrease in your top line gross receipts. Now, across the 200 facilities that I've worked with Nick and Mr. Wiley on, I can think of maybe less than a handful that were able to demonstrate this level of drop in gross receipts. And partly because even though your business was impacted, and we'll talk through what that means, you were deemed essential. You were allowed to stay open. You may have been on lockdown. You may have been not able to do certain things, which again, we'll speak about here in a second, but you were able to keep your census up, most likely. And so as such, your sales, your revenue, your income was still there. But if your business did have this decline in gross receipts of 50%, and it's quarter to quarter comparison, so example, Q2 2020 versus the same quarter in 2019, Q2 2019, if there's a 50% variance between those 2 quarters, then you can qualify for the revenue test. That extends now into 21. And part of the reason this extends, again, this is one of those amendment changes, is as we got into the pandemic of 2020, we didn't expect this to last for several years into the future. And so the CARES Act, which is what this legislation is all sitting under, actually expired at the end of 2020. Most people don't know that it expired. So the government came in and said, oh, we're going to extend it. We're going to make this more available. The CARES Act is going to be available into 2021. And that was called the American Rescue Plan. So that extended now the revenue test into 21, but it changed the numbers. You can see it changed it from 50% decrease down to 20% decrease. Still a major decline, but not as dramatic of losing 50% of your revenue. And again, just as a reminder, you'll still compare that against 2019. So Q1 21 versus Q1 19. The comparison of the revenue test, if you had 20% drop, then you still qualify on that revenue test. One last comment on the revenue test that I like to just bring up. Because this is a tough test to pass, the IRS legislation also did one other cool thing, is they said, if you pass 1 quarter in the revenue test, automatically the next quarter qualifies you as well. So we see this happen a lot in 21, where if a business did unfortunately see a decline of 20% or more versus that same quarter in 2019, then they can qualify for that quarter just on the revenue test. So let's just say hypothetically it's Q1 21, they qualify. Automatically, even if your sales doubled the next quarter, you still qualify for that next quarter of quarter 2. And again, this is only going to go through quarters 1, 2, and 3 of 21, but it's a great way if you do pass one of the tests in 2020 or 21, you press the revenue test, you automatically qualify for the next one. It's called a look forward provision, which is great that the IRS put that in there. A couple other just quick comments about the initial legislation. Then we'll talk about the next major change that took place. Initially, nonprofits, any 501c3s or other not-for-profits could not qualify for the ERC. You just were locked out. Initially, if you took a PPP loan, you could not qualify for the ERC. That was not allowed to you. Initially, if you had over 100 employees, you couldn't qualify. So what really took place here, and this is more of an opinion statement that I'm going to make, but my opinion is that the legislation started in March of 2020, and it was very restrictive. The IRS and the CARES Act just said, nope, you have to be this very specific type of business to qualify for this tax credit. And by the end of the year, they were doing their analysis, and they saw that a lot of businesses didn't take advantage of it. And it's partly because of how restrictive it was. So at that time, the American Rescue Plan, again, a big change, introduced several different amendment changes. It extended the CARES Act into 21. And then it also made a major dramatic change to this ERC. It introduced a second test that allowed for qualification. So this revenue test, 100% available throughout all of the pandemic, 2020 and 21. But then a second test came up. And that second test had an or statement added to it. So you could qualify on the revenue test or what we call the suspension test. And the suspension test is a lot more legal language around what happened to your business. And this is where the IRS came in and said, hey, we know that your business still suffered. Even if your sales went down 10%, 5%, 18.9%, if you didn't hit that 20% number or 50% mark, we know you still suffered because of the government mandates that were put in place. So the suspension of operations test was introduced, and it became retroactive. That allowed for 2020 or 21 to qualify off of. And essentially it says this, the IRS says, if your business suffered a full or partial suspension of operations because of the government mandates that were put out there, then you can qualify. Now there's some thresholds that you have to pass, and you have to make sure it's more than just one day you were impacted. But if you had more than a nominal impact against your business operations, then you can still qualify for this tax credit. Even if your sales went up, your revenue went up, you can still qualify. So what's great about this is that it opened up a world of opportunity for businesses like you and like your industry because of all the restrictions that were put against you. So a couple definitions that I'll give first. So what is a mandate? What is a government mandate? Well, in the eyes of this legislation, we're talking about the executive orders that were put out in the state of Pennsylvania, the surrounding states, all the executive orders. So Pennsylvania is very different than, New York, Virginia, Maine, et cetera, all over the place, North Carolina, where I live, all very different executive orders. There's federal mandates that were put out there with the CDC, OSHA guidelines. I mean, even the president sitting up on a pedestal and saying, do this, don't do that. Those were all mandates that said they were requirements for how we could run our businesses. A full suspension of operations would be a shutdown. So the example I like to use, which is not applicable to your industry, but the example I use is think of the restaurants in downtown Manhattan, New York City, couldn't shift to takeout, couldn't shift to delivery, it just wasn't part of their model. So what happened? They had to shut down because New York had strict restrictions on businesses that couldn't do indoor dining for so many months. And so those businesses were just forced to shut down. Again, a full suspension, not necessarily applicable to your industry because you were deemed essential and you were allowed to keep operating. But a partial suspension of operations may become relevant. And this is where businesses may be able to qualify within your industry. And we've found some good success working with others of your peers. So some examples of what government orders or executive orders that were put in place that forced you to change your operations would be like a couple that we listed here. So it could be the limitation to how you did visitation schedules, not allowing visitors to come in, having visitors sit outside and look through glass to see their loved ones. That was not an optional thing. You were required to shut down your doors and not allow visitors in. Maybe you had employees that were out with COVID. They got sick. They were required to quarantine. You still had to pay them, but they were out. Maybe there were periods where you could not admit new patients because you were on lockdown, or you were just, you had limitations around how many new patients to staff ratio you could have. Another one that we like to talk about at times is maybe there were changes to how you did communal dining, right? If that was something that you went from communal dining to in-room segregated dining, think about the changes that took place for your cost structure, your expenses, the staff morale, the resident morale, your patient morale, your customers, how upset that could make them feel. Those were all required changes that took place. This list goes on and on and on. We talk about how maybe you couldn't go see your state legislator because they were shut down as well. You couldn't go to major events and conferences like the ACA National Event, National Conference, and NCAL's national conferences because they were shut down. All of those examples, within reason, right, can become what's called a partial suspension of operations because they were tied back to government mandates.
Hey, Brett.
Yeah.
One additional thing on the partial suspension here. Can we continue that definition of partial suspension to talk about how much of a partial suspension is really needed for one of these facilities to qualify here?
Yeah. And thanks for getting me there because that's where I was going next. So as this second test came up, so the first test, revenue-based, it's black and white. You look at numbers and you do the math. You drop certain percentages, it's just doing math. The second test, the suspension test, you can see it's a little bit more vague. I say it's gray, right? So who defines what is considered enough of a suspension of operations? Well, again, we go back to the IRS. So we want to use what the IRS says is how much of a suspension do you need? They say that you need to have a nominal impact. And they actually go on and define nominal as being at least 10% of your business operations were impacted. I'll say that again. So at least 10% of your business operations were impacted because of these mandates. So not revenue, not census, not sales, not profit. This is just operations. So what our team typically does is we go through and have a discussion with the business owner. We'll say, tell me what happened. What'd you go through? And we'll have just a back and forth discussion. Did this happen? Did that happen? Tell me in your own words what took place. And they'll start to come together and say, yeah, we had this and that and that. And for so many months, we couldn't do this. And so many months, we couldn't do that. And I was told by this. And it just goes on and on and on. Now, we've done so many thousands of these now that we've developed a keen ear and eye to say, okay, I know the mandates that took place in Pennsylvania. I know that you were required to do that change. But let's talk about the timing of when it took place. Because every quarter can be individually qualified. So the beginning of the pandemic, Q2 2020, that's when the world was flipped upside down. We didn't know what was left to right. Everyone was really scrambling to figure things out. That's a pretty no-brainer that everyone was impacted in some way, whether it's revenue or suspensions, because that was right at ground zero. But as you get to 2021, Q1, Q2, Q3, every state treated COVID a lot differently at that point. So we have to really dig into the weeds and say, okay, did that really take place in quarter two? By the summer of 21, were you still on lockdown? Were you still having issues with, getting new staff and all of this? And so we'll go through that experience with them because we want to make sure there's more than a nominal impact. And again, nominal impact is 10% or more of your operations were impacted because of the government mandates that were there. Nick, does that help? Did that answer the question?
Yeah, thank you, Brett.
And Brett, I just want to take a second and go over to everybody the one point that you made relative to communal dining, because I know in the state of Pennsylvania, communal dining was stopped and everybody had to go to serving all meals to the residents in their rooms. And in my humble opinion, I think Brett and Nick normally agree with me, that if you just had that one change occur, that could potentially qualify you under the nominal impact. Because if you look at the modifications you had to make with going from serving meals in your dining room in a communal setting to having to deliver 60, 80, or 100 meals every meal to their rooms, that's a significant labor cost. There's a lot of other expenses involved with that. So that right there alone could potentially help you qualify.
Yeah, I think that's a great point, Mr. Wiley. I think it's great. And, I want to just kind of drive this point home for a second, because this is where the biggest confusion takes place in this industry right now. Again, the earlier statements I made was ambulance chasers popping up, calling you saying, you automatically qualify for $26,000 per employee. Come get this money now. And that's not the case. You can see based on just these two simple visuals, initially, the test to pass was extremely restrictive. Only certain ways, black and white, do the math. And then with the legislative changes that took place, and again, there were several of them, it became much more inclusive. And it was a little more gray. So you really need to know, okay, did I have the impacts? Was it an optional or voluntary change, or was it because of a government order that took place? And there's plenty of resources that we can share around, where those executive orders were, when they existed, when they started, expired, all of that. But it's really important to look at this because I like to say that, and we'll talk about this from a process standpoint here soon, but to qualify for this ERC is, and the process to get it is very similar to your personal tax returns, right? So essentially what I mean by that is, when you do your personal tax returns, you go to your CPA, or you do it yourself. You go to TurboTax or H&R Block or whatever it might be, and you fill out a piece of paper, and it says, here's how much my income was. Here's what my deductions were. I donated to charitable contributions or Goodwill. And then at the very end, the software or your CPA fills out all the form, and then they say, okay, review it, attest that this is correct, and then you sign off on it. And then we're going to send it into the IRS. And then the IRS reviews it and says, oh, yeah, you get a $1,000 tax refund. That's how your personal taxes go. What you don't send in with your personal taxes is your actual receipts, your data. You don't have to. You're supposed to just put that off to the side. This ERC is the same way, meaning that you can go and fill out your 941s. You can put a number on there, send it back. The IRS is going to review it. If it looks legitimate to them and the calculation looks good, they're going to approve it, and they're going to send the money back to you. What they're not asking you to do is they're not asking you to send in your substantiation. They're not asking you to send in why and how you qualified. They're not saying, Miss Business Owner, did you qualify on the revenue test or the suspension test, and how? They don't care about that. What they do care about is getting it done correct with the calculation, and then they have a window of time in the future, just like with your personal taxes, where they can come back and question you of why you got this ERC the way that you got it. So this is really important from a do I qualify or not stance, because anyone can say, yeah, you're qualified, but that's not always going to be the case. You need to make sure that you truly understand why and how, and you have proof behind it. So one thing that our team does is we actually want to build out some opinion statements to say, this is what you told me. You told me your assisted living center went through XYZ 1, 2, 3, and we found the government orders that were related to that. And we reference all of it and say, yeah, you had visitation limitations. You had COVID lockdowns because of your spiked rates went up of your bed infection rates and whatnot. And here's the legislation that actually shows that you couldn't admit new patients and residents. And so we have that direct correlation that goes back and forth, because if in a couple of years from now, you do take this money and the IRS comes back and says to you, Mr. Business Owner, how'd you get it? Why did you get it? What was your rationale? You want to be prepared. So our process would be to help you on that. But that's really important as these ambulance chasers are popping up there, that you know the ins and outs of everything. So this is a very simplified version of looking at what that the two tests are for how to qualify. As Nick said, this is 400 plus pages of legislation, so it goes really, really deep. But this is really simplified version of it. So hopefully this helps. And again, we will have time for questions here at the end. But let me move forward, because I want to kind of talk through some simple objections that I hear all the time. So some of those objections would be things like this here. We hear all the time, we don't qualify for this because we're an essential business. That's a very common question that I get. Or we don't qualify because we never shut down, right? And again, I think we kind of belabored the point here, but it's a shutdown doesn't have to be a full shutdown. As an essential business, you're correct. You never stopped your operations, but you may have had partial or changes, disruptions, and impacts to your operations. And if they're related to government mandates, then you can still qualify. Or we still hear, I didn't drop revenue by 20%. We don't qualify. Again, that's page 1 of the legislation. Yes, that you had to have a revenue test. But then because of all these amendment changes, that's not a requirement. It's one or the other at times. Another one I hear a lot is, we took the PPP. I was told I don't qualify. Again, I don't want to kind of go backwards too far here, but yeah, that was initially something that was a restriction. You had PPP, you couldn't get it. Now you can get both. Now, the PPP is very important because that's a payroll protection program, and this is a payroll tax credit. So there is some additional formulas that have to go into account of how you equate both of them to make sure there's what's called a double dip. There's no double dip that takes place. So if you did take a PPP or both rounds of the PPP, then you do qualify for the ERC. You want to make sure that you work that out with whatever processor or math that you do internally, that you don't double dip, because that can be a negative in the eyes of the IRS going forward. And then again, on almost a daily basis, we hear, we're a nonprofit, we don't pay taxes, we don't qualify. And I think that's a big distinction, that nonprofits still pay payroll taxes to their W-2 employees. They may not pay sales taxes. So you still can qualify for that if you're a nonprofit. Okay, these lists go on and on of common things we hear, but these are the big ones we hear quite often. And then let me walk you through just kind of a process of, if you were to decide to work with someone like us or other processors, they might have a similar kind of approach. But as Nick said, this is how we provide a member benefit to everyone that we work with through Mr. Wiley and Nick here with ACA and NCAL. But our process is pretty straightforward. So we don't want to put you under contract. We don't want to require you to sign your life away. We first want to just be able to make sure that you are qualified. So it typically starts with a quick 20-30 minute pre-qualification call. That'd be with myself, Nick, and Mr. Wiley if he's available as well. And a quick call. We go through the details. A lot of it will be a reminder to what we talked about today. But then we get very specific to your individual needs of what your business went through. Because even though you might be identical to another facility 2 miles away, your experiences were different than theirs. And you treated COVID differently. So we want to make sure that you were impacted the same way. Assuming you are qualified, we'll get into document collection. There's some documents we need, which we'll talk about here next. It doesn't take but more than 10-15 minutes to get the documents collected. And then we do an analysis. So again, we're not asking for contract yet. We just want to first make sure that there's no red flags and there's no issues with the data that we see. It takes our team about a week to do the analysis if you decide to work with us. Once we come back saying, yeah, this all looks good, everything checks out, there's no issues, that's when we would send you our partnership agreement. We work very similar to like a contingent law firm, where if you decide to work with us, we don't charge any fees up front. We only charge fees if you win and get that money back. Then we would take fees out of the proceeds that you get. And we charge 15%. That's pretty much an industry standard for this now. But we have heard some crazy numbers up and some more inexpensive versions down. Assuming you sign, though, we do all the filing. We do everything for you. You don't have to worry about trying to figure out your 941X. We do all of that. And then depending on the size of your credit, it can take 3, 6, 9 months to get some money back. So this is not going to be fast cash for your business. But the process is pretty straightforward. From start to finish with our group until we get filed, if you are qualified, it takes no more than 2 weeks. And so it's a pretty streamlined process. And then we get into the line with the IRS. Really quickly, I just kind of mentioned the documents that are needed, whether, again, you work with someone like us, you do it yourself, or you work with a third-party processor. Anyone is going to need the following. They're going to need your 941s for the timeframes that you're qualified, whether that's 2020, 21. Each 941 is 3 pages long. If they're not asking for all 3 pages, that's a red flag. You want to get all 3 pages over to your processor to make sure that nothing's missed, and how the calculations are completed. So that's number one. Number two is you'll need to look at your detailed wages. Again, your W-2 wages, who you paid, what you paid, when you paid them across those timeframes, and you want to make sure that they match up, right? We still today see quite a few businesses that send us payroll wages, and their 941s, and they don't match. And there was an error at some point. So we have to kind of advise them on how to fix that before we do their processing of their ERC. So that's number two. And then number three would be, if you did take a PPP loan, you need to make sure that's shared with your processor, so they can make sure that the calculation is done correctly. So that's all you need. It's not a lot of documentation on your side for at least calculating the credit. There is a maximum of $26,000 that can come up. Oh, and forgive me, I missed this one. So yeah, if you're working with us, we'll ask, who's the authorized signer. If you have family members on payroll, then that can be excluded. There's some restrictions around that as well, but that's kind of deep in the weeds we'd get into. As I mentioned, it's $26,000 is the maximum you can get per employee over that time frame of 2 years. Now, doing this 7,000 times over, we've yet to see a business get the maximum. So this is another red flag. If someone tells you that you're just going to get $26,000 and say, "Oh yeah, everyone gets $26,000," that's false. No one gets $26,000. It depends on their payroll. It depends on the time frame. It depends on the PPP loans. So there's definitely restrictions around that. On average, I'd say in your industry, it can be anywhere from 10,000 per employee, 15, 18,000 per employee is a range, but everything is unique. It depends on your payroll. It depends on all of those restrictions that we talked about. Couple reasons, then this will be the only sales pitch of why to look at someone like us is, this is all we've been doing for the last 2 years. We still have our staffing and payroll side, but my team is about 60 employees that are dedicated just to the ERC. We do this every day, just supporting businesses, making sure that we can help get you the right information, do it without getting you under contract, just giving you education around it, maximize your refund, and then only charge you fees if it comes back. And then because of all the IRS agents we have on staff, the attorney generals, we've got some audit protections that we put in place. We want to make sure that everything's done right, and we put our fees on the line. So if anything was ever done wrong and it's on us, then we actually refund our fees back to you. So we want to make sure everything was done right up front and there's no issues from there. That is all I've got for today. I know I've been long-winded, but hopefully this is a lot of good detail. I'm sure there might be some questions. I think I saw one even come through. I'll leave this up talking about questions though. But Kimberly, Nick, Michael, any other questions?
Yes, so I'll step in here. Just a reminder, I know there is one question that was submitted so far. If you do have a question, please click on the activities icon at the bottom right side of your screen and go into the Q&A section, and you can enter a question there. Nick, I'll hand it off to you.
Yeah, thanks, Kim. So I'll address the one question that's in there right now, and then I'm going to bring up a different document to show something else while anyone else wants to type in anything. But Diana had said, we have a management company and 2 separate standalone life plan communities, all separate EINs, all separate payrolls. However, some employees are shared between companies. Would we be considered separately for FTE count or consolidated total? Thanks. So Diana, the real question there is the ownership structure. If the management company owns the 2 buildings or it's common ownership between the 3 EINs, you would then be considered an aggregate control group between those EINs. And the sharing of employees between one company and another is very common. When it comes to FTE count, they would be considered partial FTEs at each of the employers at that point. So you would have a separate portion EIN for each of them at each EIN. But if the management company owns the communities, or if the same entities, same operators, or same individuals have majority ownership of the management company and the EINs, then you would be considered the consolidated total for the FTE count.
Yeah, and I see that she actually just responded, said the parent company owns the 2 subsidiaries. So it's something we'd want to look at. Ultimately, because this is a confusing area of the legislation, we'd want to make sure, if you want to put us under NDA or anything like that, and you chose to work with us, that is, we just want to look at the splits, the ownership, what flows where, to make sure that it's all just considered properly. It's typically not an issue. As you get larger to employees, that's when it becomes concerning, because we want to make sure it's under that 500 level. But if you're 100, 200 employees and you're considered an aggregate control, there's no concern there. Okay. One thing I'll just add, I think this is complementary to what Diana's talking about here and whatnot, is we didn't get too deep into the calculation of how this works, but ultimately, I'll just say this. We talked a lot about the FTE count for 2019 as your baseline count. Once you establish what size employer you are, it doesn't matter what happens in 2020 and 21. So a good example would be, let's say that you're on the threshold of being a large employer. You have 450 employees, which is a lot. That's a lot of employees in 2019. And then 2020 comes and you acquire another op-ed, or you grow your staff, and all of a sudden you're at 550, 600 employees. At that point, it doesn't matter. You're not going to be a large employer at that point, because your baseline was established as under a large employer status. And then also, once you get past your baseline understanding of what you're at, then every payroll is included. You're either qualified or you're not. And every payroll, whether someone worked for 2 weeks and then they quit, fired, left, or they worked 80 hours a week for all 2 years, every pay period is going to be looked at. Every payroll is going to be looked at. Nick?
Brett, yeah, I wanted to just show this just as an example. This was based on a conversation that Brett and I had with a standalone single SNF in Arizona. And this is the backup data that we're talking about that you really need to have available in the time of an audit. So the numbers here of 1 through 8 were based on the discussions that we had with the operating company. Here were the changes, the impacts against them. And then what Brett's team did was tie it back to the actual Q&A from the IRS, and then take the executive orders from the state of Arizona that made it a mandate for all of those changes to actually be in place. So this is the backup data that you would be utilizing in case of an audit. So if it ever comes down to it, here's everything that would, say the governor said this in Arizona. This is why we were impacted. This is why we have more than a nominal impact of 10%. So I think that's important for you all to understand as well, making sure that you can tie back those mandates to the actual impacts on your operation itself.
Yeah, and I'll just add to that, Nick, that a big question that I get often is, what should you as the business owner collect? What should you prepare? What should your file look like? Just like in the example of the personal tax returns, what should your folder of receipts look like? So my answer to that is actually pretty simple. Is I recommend that we're in 2023 now. This legislation is going to go for a couple more years, even though we're always going to talk about 2020 and 21. And so a couple of years from now, if you take this money, the IRS could come back and they're going to start asking questions. So if that's you and they do ask you those questions, you want to be prepared. So what I recommend is now have your administrator, your managers, your staff, the management company, the owners themselves, write down your own narrative. Explain in your own words what happened, what'd you go through. And it could be very detailed, a couple pages, half a page, whatever you want to do. But write it down now. Print that out, put it off to the side. Because if you're like me, I'm in my 40s and I feel like I can't remember what happened yesterday. But a couple of years from now, I'm not going to remember what happened today. So if I write it down, or you write it down of what your experiences were, that should help just from a recollection perspective. Additionally, if you have any communication from ACA, NCAL, the Pennsylvania Healthcare Association, that says, hey, Mr. Owner Operator, this is what we're advising, this is what we're recommending, this is what's going on, this is what legislation says, print those communications out. Just have a record of them. And I always like to recommend printing them out, because you never know what the digital world's going to do, right? If your server goes out, you lose 2 years of information, that information's gone. But if you print it, put it off to the side, just like it's recommended to do for your personal taxes, then you'll have a record of it. So I like having that, the narrative, any communications. Our team, if you chose to work with us, would have our own file, case file, that's put off to the side, which includes the calculation, which includes the substantiation, the opinion statements, the executive orders, all of that. So we do have a really robust file if there's ever a need for it in the future.
Does anyone else have any other questions?
I've been watching the Q&A channel, and I also, Nick, I'm sure you are also looking at it, but I don't see any questions that have come through. As a reminder, if you have a question after today's session, feel free to email myself, and Nick's email is presented on the screen currently. Don't be shy. Feel free to reach out if you think of anything after the session today. Does Nick or Mike, do you guys have anything else to add? No?
Nothing from my end. Great job,
right.
Brett, as always.
Thank you.
Okay,
Thank you for your time, everyone.
Thank you so much for joining us today. Everyone, enjoy the rest of your week.
Thanks, guys.
Bye-bye now.